Hey, what's up, everyone? Welcome back to my world of stocks. My name is Ale, of course. So I got another request on Discord, this time from Tim, who said in the video suggestions channel or tab, whatever it's what it's called on Discord, but he said that he enjoyed my previous update on the tariffs and was wondering if I would consider doing a weekly update on the tariff situation since it's so up and down and somewhat all over the place. It's hard for me to keep track of everything going on. Well, Tim, that's actually not a bad idea, and I'd be more than willing to do something like that. However, the only concern that I might have with a series like that is I would probably want to wait and see how well received a video like this is before I commit to doing it like a consistent little weekly series. But hey, let me know, guys. If you want a weekly update on this entire situation, drop a comment, hit that like button. That'll tell me that you guys want this to continue. And yeah, like I said, I'd be willing to do a weekly update for you guys because I know this is a very volatile, developing situation here with a lot of changes happening pretty much on a daily basis at this point. And whenever anything changes with trade deals or tariffs or anything else, it is wildly moving the stock market, which I will show you in today's video too. So yeah, I think a weekly update does kind of make some sense. So yeah, I'm more than willing to do that. Now, for this video, to kind of start things off, I think the best way to do this for you, Tim, and for all of my viewers here, would be to really separate the video into three parts. I think I'll start by kind of summarizing all the tariff moves of the past week. Then we can look at how the stock market reacted to all of it and how the market is performing. You're going to see it is extremely volatile. And then we can kind of just finish up at the end with my own thoughts on everything that's going on and how also investors can prepare and kind of navigate through this super volatile environment. So I'd love to give you guys some tips, some advice, some friendly advice that I think can help investors. And of course, I'll let you know what I'm doing myself too to navigate all of this. So I think it'll be a fun video here. I hope you guys enjoy it. And like I said, if that sounds good to you, hit that like button, but let's go ahead and jump straight into this. Now, just to give you guys a really quick summary of everything that really kicked off this whole how everything really started, this whole tariff situation. Well, on April 2nd, we had Trump call that day Liberation Day, where he introduced a sort of two-tier tariff structure with a baseline 10% tariff on imports from nearly all countries, as well as a higher country-specific reciprocal tariff targeting approximately 60 different nations as well. Now, most of it is stemming from really the massive trade deficit that America has with the rest of the world. It broke a new record high last year, surpassing more than $1.2 trillion. And like I've said before, guys, this is something that I think really both political sides agree is an issue for America. They just disagree on how to go about solving that. Trump wanting to use tariffs, Democrats wanting a solution that they feel wouldn't hurt the country by so much and hurt other countries too, and escalate, cause trade wars and stuff like that. So the two sides just kind of disagree on fundamentally how to solve this problem. Whether which side is right, I'll leave that up to you guys. I'm not going to get political on this channel, but another thing that has been, of course, an issue aside from the trade deficit is what Trump feels are unfair practices by other countries and how they're treating America, and particularly, of course, China. And we've had a history with China going back and forth, this going not just with other presidents that we've had, but even Trump in the first term, we had an escalating kind of trade war there and a lot of tension. And now it looks like that's really starting back up again under the second term here of Trump. Now, unfortunately, the stock market tends to really hate these type of environments where there's so much uncertainty and back and forth and escalation and stuff like that. And so that announcement where Trump, first initiated those tariffs, it ultimately led to a very big drop, which we will cover here in just a second when we move into part two and we talk about the stock market. But before we dive into that, just want to kind of catch you up to date with everything that's happened since then. So since that initial announcement of tariffs, there has been several developments, including a 25% tariff on imported vehicles and a back and forth escalation with China to the point where America is now implementing a whopping 145% tariff on them, and China is doing 125% 25% back on America too. Now, in response, and by the way, those are massive, massive tariffs. I mean, you're talking about, potentially prices of goods skyrocketing if those tariffs stay in place. And by the way, those tariffs are not sustainable. Like, you can't be tariffing that much. We'd have to kind of negotiate and make some deals, which is assumingly what will happen eventually. But at the moment, very high tariffs and a lot of volatility, a lot of extreme stuff going on there. Now, in response, Trump also created, and in response to China kind of retaliating to America, Trump also created a 90-day pause on reciprocal tariffs with all other countries as they negotiate new deals. But that two things that does not include. It does not include the 25% auto tariff, so no pause on that. Apparently, that's from my understanding. And it also does not include any of the escalations that we've already had with China. So those massive China tariffs, those are staying in place. Now, at the moment, there is set to be over 70 different countries wanting to make new deals with America. That's a big positive, right? You really want to get deals done. You want tariffs to go down, and you want better trade deals and practices going on between America and other countries. So over 70 of them wanting to make a deal with America, that's a good sign. And this includes major countries like Japan, who obviously wants to they want to get rid of that 25% auto tariff, right? Like, so many extremely popular cars come from Japan. What is like Honda, Toyota, there's others. So they immediately want to get rid of that 25% auto tariff. So they're going to be coming to the table wanting to make a deal. There's, of course, Canada and Mexico, who have strong ties, geographically and politically with America. There's the European Union, who previously said they would retaliate, but they've now actually taken a step back. And I believe they're saying now that they're not going to retaliate, and they instead want to negotiate a deal, get a deal done with America. There's Vietnam, who America has also had a fairly large trade deficit with. So there's been tensions there. But they're now offering to balance out that trade deficit too. So that's another positive sign. There's Taiwan, who, of course, relies on American protection from China. So they obviously want to be friends with America. So they're going to be coming to the table. And there's many more countries, many more examples just like that. I did a video back during the week where I listed a bunch of countries, and I kind of said how they're all wanting to come to the table. But yeah, just so you know, in summary, there is a lot of nations wanting to make deals with America now after these tariffs have been implemented. And of course, a lot of those countries, their economies really rely on America for their economies to stay afloat. So they're going to want to get a deal done sooner rather than later. And they've got that 90-day pause to help them out, to, kind of just to calm things down a little bit so that the countries can actually negotiate, right? And you have less tension and less flare-ups. Now, apart from that, all eyes really seem to be on the China situation, because that's really where we've seen the most retaliation, the most escalation. And of course, those are the two countries with the biggest economies in the world with dramatically different political philosophies. So you can see why there would be so much tension between them. On the more kind of positive side of things, though, we have at least seen the two sides give more optimistic statements recently towards the end of the week. We had the White House press secretary saying on Friday, this is the day I'm recording this, that the president has made it very clear that he's open to a deal with China and that he's optimistic about it. On the Chinese side of things, their commerce ministry has repeatedly stated that the door to talks is open, but that the dialogue must be based on equality and mutual respect. And they've still been condemning the use of pressure and threats by America, at least from their point of view. And so that's kind of where we are today, all of which, by the way, has caused the stock market to be extremely volatile. So let's move on to part two now, talk about the markets. Now, the NASDAQ, for example, it actually lost the largest amount of points in stock market history when the tariffs were first announced, with the market in total losing over $3 trillion. It's mind-blowing. Then we had the day that auto tariffs were announced, which continued the free fall even further, pushing the NASDAQ into a technical bear market. Then we had the 90-day pause announcement, which sent stocks soaring back up to what was the largest point gain in history for the Dow Jones Industrial Average. But then China retaliated with the new 125% tariffs, and that sent stocks falling right back down. And it marked the fastest 2-day whipsaw in market history. How crazy is that? I mean, you're talking about extreme volatility, and it only continued on Friday, which is again is the day I'm recording this, as the Fed actually came out and said that if things get worse and the economy starts hurting, they'd actually be willing to come in and use all the necessary tools to support both the economy and the volatile markets, which would probably mean rate cuts, injecting liquidity, or just signaling easier policy. Either way, the market is always going to love that. So that caused a bounce back for the end of the week, sending the markets actually, putting them positive for the week. The S&P 500 is actually up 10% this week, but still it's negative for the year. And it is also down about 13% from the top, while the tech-heavy NASDAQ climbed even more this week at around 11% gains, but it is still down 13% this year and 17% from the top. In other words, the market as a whole, while still not, down a giant amount, it is technically going through a correction, and it could very easily slip back into a bear market on any negative news. And many stocks individually, by the way, are struggling much more than that, with even popular names like Apple down about 19% just this year, Google is down 17%, Amazon is down 16%, Tesla is down 33%, and Nvidia is down about 20%. And they're down even more if you calculate it from their highs. So actually, tons of stocks are well into a bear market at the moment. And again, that could very easily get much worse throughout this year, especially if we fall into a recession or things escalate between the US and China. There's many things that could drag stocks down much further than this. But at the very least, I think we will continue to see just extreme volatility. So let's run through now some things that I think you can do as an investor to prepare for that, and even some things that I'm doing myself too. Now, for me personally, I'm obviously willing to buy any stock that I see out there that looks attractive the more that it falls. However, I will say that there are really two specific types of stocks that I'm focusing the most on, that I'm trying to put the majority of my money in throughout this year above anything else. And that's number one, I want to buy the biggest, most dominant tech and growth oriented giants that are getting hit really hard right now, but that I feel wouldn't otherwise be able to get such a big discount on if it wasn't for the market having to, tank as a whole and drag these stocks lower. So stocks like Google, Amazon, Meta, companies that are just amazing at what they do. In the case of Google, you're talking complete domination of the internet and digital advertising with huge promise in AI. With Amazon, okay, nobody comes close to how insanely large they are at this point with e-commerce. Nobody here in America can match their massive infrastructure and get almost any product imaginable into your hands within days, sometimes even hours. You look at Meta, complete domination of social media, and just so insanely profitable from online advertising too. Well, these are companies that quarter after quarter just crush their financials all the time. They're always outperforming, and their stocks are just so resilient and strong because of that, it just makes it really hard to get any kind of big dips or discounts on. And the same goes for even some riskier names like maybe Nvidia or Palantir, who are absolute high flyers, high growth stocks, some of the most popular names out there, putting up some of the best numbers in the market with practically everyone wanting to own those stocks. Well, for those types of stocks, you are going to likely need a market-wide downturn just to drag them down lower to more attractive levels to where you can actually start buying in and feel like you're getting a good deal and feel like you're getting some cheap prices. So those are the areas that I will continue to be the biggest buyer throughout all the volatility. But then there's number two, which is dividend stocks. I mean, plain and simple, give me some of the best companies out there with large dominant businesses, preferably market leaders like Medtronic, Verizon, Vici Properties, Extra Space Storage. I mean, shoot, even Pfizer. Just give me market leaders that are paying huge dividends, that are getting dragged down by so much to the point where now you not only get a great stock price at a great valuation, big discount, and you're going to have a very low cost basis that will help you for a future rebound. But on top of that, you also get some giant dividends with much higher yields than anyone else that will have to buy in later at a higher price when the market rebounds. If I get these dividend stocks now at these lower prices at a low cost basis, I'll be collecting high dividends, theoretically for many years at very high yields, while anyone else buying in later, if they wait, if they didn't take advantage of the dips, if they didn't take advantage of the market downturn, they're not going to be getting the same dividend yields that I'll get to collect for many years down the road. So I'll be scooping up as many dividend stocks as I can this year. I think it's really going to be like the year of the dividends for me because of how many dividend payers I'm going to be adding to my portfolio. It's probably the thing I'm most excited about is just getting some great dividend stocks throughout this market downturn, because I think, again, it's going to be extremely volatile and perhaps everything might be going much lower and a lot worse. And I'd love to be able to get lower prices on those stocks. Now, having said all of that, I think the majority of people out there should still proceed with some caution. And here's a few tips that I would give them, especially to any beginners out there, but also even some more experienced ones too. Number one, make sure you diversify. And I know that that's not the most exciting thing to do. I feel like these days, everyone is just trying to make a really quick profit by going all in on just a couple stocks. And a lot of, videos out there on YouTube and stuff and elsewhere, everybody's saying, go all in on this stock, going all in, you just need this one, whatever. But the reality is that if you spread your investments across various different types of stocks, going for not just growth, but also some value, maybe some dividends, and even across different sectors too, well, it's ultimately going to safeguard you much more through a volatile environment. And trust me, when things get volatile, when the market is tanking, the diversification, you're going to be happy that you're diversified and you don't just own, a couple of stocks that take a much bigger beating than maybe some safer stocks that you also elected to add to your portfolio. Number two, just like I'm doing myself, I would focus on quality. I can't stress this enough. If you invest in companies with the strongest businesses out there that you know will succeed long term, then any price drops right now will ultimately be just huge buying opportunities because you know that they can rebound once the market and the economy stabilizes. So it makes it a lot less stressful and a lot less risky if you know that they're going to do well long term. Number three goes with number two, but I'd say, stick to that long term investing strategy above any other strategy. I think it's the best in my opinion. Anything can happen here in the short term, and there will likely be lots of moments of pain, but years down the road, you'll be glad that you took advantage of some of the lowest prices that you can get today, this year, while you're riding up that big wave of recovery later on. So even though short-term fluctuations are common, don't let it phase you. Focus instead on your long-term investing goals, and you'll likely see success with it. Which leads me to number four, just to only invest with what you can afford to lose. And this is, I would say, really high emphasis on this. This is not the time to be throwing your rent money at the market. If things escalate and get worse, if it triggers a recession or something else, you don't want to find yourself taking on massive debt just to cover your regular expenses, which is extremely counterproductive to any long-term investing strategy where, debt can really become one of your biggest enemies long term because it snowballs. Then you've got interest on it, and it just makes things even worse. It's the worst thing that can happen to a long-term investor. So you want the opposite of that. You don't want debt. You want assets. You want investments that will actually generate money for you, not take money away from you. And then finally, number five, stay informed, guys. Now I'm going to do my best to update you here as much as I can. And like I said, I'm willing to do a weekly update if you guys want it. But it's absolutely not going to be enough. Even if I make a daily video, it's not enough. As always, you're going to need to be consistently doing your own extensive research and making your own informed decisions. I know it's not the funnest thing to do, but the more alert you are to everything that's going on, the better position you'll be to make smart decisions for yourself, for your own investing strategy, for your own portfolios. And you'll also be able to find the best deals in the market if you're staying on top of everything that's going on. So yes, be patient and cautious where necessary, but also be alert and proactive too, with a long-term mindset on any stocks that you're looking to pick up. And make sure you take advantage of those opportunities throughout this year. Okay, so that's going to do it for this week's update. Again, let me know if you'd like another one next weekend. But thanks again for watching, for stopping by, for all of your support. I hope you're all doing well out there. Thoughts and comments, leave them down below. But I will catch you in the next one, my friends. All right, take care, everybody. Bye-bye.